July 24, 2026, one of the fastest rising investors alive sat down to write to the people whose money he managed. His name is Leopold Aschenbrenner. His hedge fund, a private investment firm, was up, by its own reported accounting, more than 1,500% since launch, in under 2 years. Markets were shaking. AI stocks were falling hard. But his letter called the sell-off one of the best buying opportunities in over a year. And at the bottom of the letter, a postscript. At times, we call out opportunities that seem like a particularly good time to add funds, if you have been waiting for one. He was inviting fresh money in. 6 days later, he was forced to sell almost everything. Nothing in finance is supposed to move this fast. This is the story of those 6 days, and how one of the world's biggest new funds nearly died in less than a week. 6 days in July. The rise was as abnormal as the fall. At 19, Aschenbrenner graduated first in his class from Columbia University. At 22, he was inside OpenAI, the company behind ChatGPT, until they fired him. OpenAI said he leaked internal information. He said he had warned the board about security. The firing is fact. The reason is still disputed by both sides. 2 months later, he published a 165-page essay arguing that machines matching human intelligence could plausibly arrive by 2027. Silicon Valley, read it. Wall Street, read it. And when he turned that manifesto into a hedge fund, believers lined up with their money. The fund launched in late 2024 with, reportedly, around $225 million. Less than 2 years later, CNBC put its assets at $45 billion. Reported returns, 439% in a year, while the broader market managed about 9%. All of it run, reportedly, by a team of 8 people. Only 4 of them, investment professionals. Rival funds tracked his public filings. Retail traders copied his every disclosed move. Some in the press called him an oracle. But the engine underneath those returns was not vision alone. It was borrowed money. Here is how the machine worked. The fund bet big on the picks and shovels of the AI boom. Memory chip makers like SK Hynix and SanDisk, data center operators like CoreWeave and Nebius, the physical backbone of artificial intelligence. Against them, it bet on decline, borrowing and selling shares of software companies it believed AI would disrupt. Reports named Adobe among them. When a stock you have sold falls, you profit. Long the winners, short the losers. Wall Street calls the gap between them a long-short spread. His was famous, and famously profitable. Then came the multiplier. The fund reportedly ran about 4 times leverage. For every dollar of investor money, roughly $4 at work. The rest borrowed from banks. Leverage is a simple bargain. It multiplies wins and losses by the same number. 4x turns a 10% gain into 40. It does exactly the same to a loss. And there is a catch. When leveraged bets fall, the lending banks demand extra collateral, cash to protect their loans. That demand has a name: The margin call. If you cannot pay, the banks sell your positions for you, at whatever price the market offers, whether you agree or not. In a rising market, nobody thinks about this machinery. And in June 2026, AI stocks stood at record highs. Nobody was thinking about it. Then, June ended. In July, the AI trade cracked. The semiconductor index fell nearly 30% from its June peak. An index tracking the market's hottest momentum stocks dropped by more than half. The names at the center of the storm were the names at the center of his portfolio. SK Hynix, SanDisk, Nebius, CoreWeave. In his own later words, many AI names drew down by half or more. And the other side of the machine failed at the same time. The software stocks the fund had bet against did not fall with the market. They rose. In his letter to investors, our positive long-short spread, quote, reversed violently. Both engines in reverse, multiplied by 4. At 4x leverage, losses eat the fund's own capital first. As that cushion shrank, the margin calls began. You might ask, why not simply wait for prices to recover? Because once the margin calls begin, the manager no longer controls the clock. The lenders do. Then came the part no risk model prepares you for. Everyone knew what the fund owned. Its filings were public, famous, copied. As the fund weakened, traders began hitting exactly those names. His letter again. We started to see increasingly adverse trading in names publicly associated with us. He compared it to a bank run. Vulnerability begetting more vulnerability. The fame that had raised tens of billions had become a targeting system pointed at his own portfolio. By late July, the fund was fighting, in his words, as positions rapidly moved against us and market liquidity dried up. Liquidity, the ability to sell without crashing the price. Now, count the days with me. Thursday, July 24th. The half-year letter goes out. The fund has, quote, not been immune to the turmoil. But this, it says, is a buying opportunity. P.S. / a particularly good time to add funds. Friday, the weekend. Monday, Tuesday, no rest anywhere. Extreme moves in core positions. The next letter would later admit, as leveraged AI trades unwind across Asia and feed the spiral. Wednesday, the Financial Times reports the unthinkable. Situational Awareness is talking to investors about selling assets or raising fresh capital. Within hours, at least 3 multi-billion-dollar funds were reportedly circling its portfolio. On Wall Street, blood in the water travels fast. Wednesday evening, at a $71 billion fund called Citadel, the phones come out. Its founder, Ken Griffin, does not wait for the call. He makes it. Griffin has a decades-old reputation. When a leveraged fund is dying, he arrives with a checkbook. Reuters reported he spoke with Aschenbrenner directly. Through the night, Citadel's senior team goes line by line through the wounded portfolio. How big? How liquid? How badly hurt? Other giants circle with rival bids. Millennium, Jane Street, according to people close to the talks. But speed has always been Citadel's edge. In the small hours between Wednesday and Thursday, the fund acts. In its own words, decisive action to protect investor capital. One block transaction. Citadel takes the bulk of a roughly $16 billion stock portfolio, reportedly at about a 10% discount. Understand what Citadel was doing. Because it was not a rescue. By its own playbook, it was buying one of the world's most famous AI portfolios at a discount from a seller who could not refuse. Not charity, opportunity. Thursday, July 30th. 6 days after asking for more money, the fund has sold nearly every public share it owned. All short bets closed, all borrowed money repaid. Assets, by CNBC's count, down from $45 billion at the peak to roughly 10. The portfolio's value has fallen 67% in a single month. That evening, a second letter goes out to the same investors. It opens with 5 words. "We let you down this month." The letter, later published in full, is unusually direct for Wall Street. Quote, "We came closer to permanent capital impairment than is acceptable to us." Permanent capital impairment. Losses so deep, the money never comes back. The letter continues, "I take full responsibility for these events. We embrace volatility," he writes, "but it should never jeopardize the fund." And the sentence that reads like the whole story in miniature. "Our fund must always be structured such that we can take a loss and fight another day." He calls the month's damage very expensive scars and promises they will become invaluable lessons. And then, one number that is easy to miss, even after losing 67% in July. The fund reports it is still up 80% for the year. Read that again. Down 2/3 in a single month. Still, on paper, one of the best performing funds of 2026. One more line, near the end. "Virtually all of my capital," he writes, "is in the fund. When his investors lost, so did he." That is what 4 times leverage does to a great year. And that is what it does the moment the year turns. So what is left? More than you might think. The forced sale touched only the public stocks. The private investments survived. Above all, a stake in Anthropic, the company behind the AI assistant Claude, reportedly worth around $5 billion. Anthropic was valued near $1 trillion in its latest funding round, and is widely reported to be heading for a stock market listing within months. His best asset may still be in front of him. The fund itself continues, smaller, and for now without borrowed money. In its own words, long stock, fully paid for, no margin, no liquidation risk. And here is the uncomfortable part. His core claim was never actually tested. AI fundamentals, he argues, kept improving all through July. Only the prices collapsed. Which means he may have been right about the future, and still lost the present. In markets, being right is not enough. You must stay solvent long enough to be proven right. An old Wall Street warning says markets can stay irrational longer than you can stay liquid. Leverage does one thing above all. It shortens exactly that clock. The fund survived. The leverage did not. And somewhere inside Citadel, the positions he spent 2 years building now belonged to someone else. Was this one of the greatest forced sales in Wall Street history, or one of its smartest purchases? The answer will not be known. For years, 6 days, that is all it took.